Stream's just setting up.
Perfect.
How's your morning, Jordan? You close out anything this morning?
No, I did not actually. I just have a few remaining positions on, and that's about it.
Nice. How do you determine for your book like how long you hold a position?
Until the edge goes away, man, or until either edge goes away or my risk limit is hit. So like I'll look at my book through a theta lens. So, meaning the higher the theta, the more risk my book has.
Okay.
So in theta, in the retail world, is considered like the time decay value. So if I have too much time decay, I mean I'm packing on risk somewhere, right? Because obviously
packing on the risk somewhere else,
right? Because time decay doesn't come for free. So
so maybe like your volatility's gone up or something,
right? Or I have too much gamma exposure, right? Maybe my options are getting too close to expiration, or I sold too much volatility. So that's how I'll look at my book. I always have my theta mark there just to see, okay, well, how much risk am I taking today? And then so yesterday, for example, my theta mark started getting above my threshold.
Yeah.
And so I had a position on basically, it was a wider strike. It was like a strangle.
Yeah.
And the stock was moving towards that band. So as it moved towards, the gamma increased substantially, right? And my theta picked up, and then I had to manage my book, hedge out my deltas, and see if if I could reduce that theta somehow.
Jeez. Yeah, man. So today I thought we could do something kind of cool. Like we'll swap it around today. Instead of usually we start by scanning the market and everything, but we've looked. It's a little bit quieter today. We're still going to search for opportunities, but I wanted to sit down today because like what you said there, for example, about how you manage your book and how you manage a position, right? Where you are looking for either your risk tolerance to be hit or for the edge of your trade to actually disappear. I think that's something that's worth spending time on because managing positions, I think, is one of the downfalls of most average traders, because what ends up happening is they see a gain, they take it, but then they see a loss and they let it run. Dude. And it's a logical place that comes from. It's like, you'll often hear people say like, oh, as I start making money, I want to start taking profits off the table.
Yeah.
They don't know why they're taking the profits besides the fact they've made money. Right. But then when they have a loss, it's like the opposite. It's like, instead of taking risk off the table, it's like, maybe I should be averaging down. Or maybe if I hold on, the price will go back up and I can exit at a better price. And you go from this, you initially put on your trade from this place of like, I know what's going on. And then the market starts changing and your position starts fluctuating in some way for positive or negative. And it's like all of that planning goes out the window.
Yeah.
Like all the planning goes out the window. And I don't know if people realize that it happens. Right. And what's really crazy, just realizing it now, is I think that's what people mean when they talk about emotional management, is actually the inability to manage the position well. They put the management of the position on their emotions instead of considering that the management of the position is actually still a part of the strategy.
Yep.
Right. So it's like, instead of saying like, I should be taking profits when incrementally as I start making money, I should be taking profits, or, I should let my losers ride out a bit to see if they'll bounce back, or just setting a hard stop. Right. It's like, well, why would you actually want to take your money off the table? And it comes back to the start, which is like, why did you get into your position? Right. So if you're coming from a place of discipline where you're like, you know what, I see this pricing inefficiency, I think this is going to happen. Here's my reasoning. This is why I'm entering the trade. Shouldn't your reasoning for exiting the trade be either you were right or you were wrong? Or the edge has gone away?
Something else as well is the confidence level. Actually, I just want to say, like, dude, how funny is this? I've been wearing this, like, I think I've worn this shirt for like a week now in a row, 7 days in a row. You're in quarantine when?
Yeah, I know. Hopefully you've been washing it every day.
Yeah. So what I noticed was, if you don't have confidence in your system, then you're always going to be changing it. Like, you're always going to be changing your money management. It's going to be hard to stay in the trade. It's like, if you look at a blackjack dealer, he knows exactly how to play the game, and he's not trying to change it because he knows he has an edge. So he's not confident. Like, the casino is confident in their ability to make money month after month because they know that their systems have an edge.
Exactly.
But when you look at someone who's not confident in a trade, then once something bad starts happening, you start questioning yourself, or something good starts happening, you're like, okay, maybe I should just take my money here because I'm not too sure if it's going to keep running. Right. So that's one thing I think a lot of people fall trapped to, is that they blame their emotions for it. But the actual thing was, when you got into the trade, you weren't 100% confident in it.
Mm.
It was almost like you were gambling. So once you can build something that, you have complete confidence in, it's a lot easier to be like, okay, well, this was my plan originally, and I'm just going to wait this through.
No, that makes a lot of sense, man. It's like, yeah, and you know what? You know what's really cool about that? You can tell when someone has that, because when the trade's over, they don't look back and go, "Oh, like I would have seen this here, or I should have seen that there."
Yeah.
It's like, I knew what I got into. It was a good bet. I'm out.
Yeah, it's 100%. That's 100% the case. I think one thing that I struggled with originally was that exact was that exact thing, right? Is I go into a trade, I wasn't confident. It start going for me. I'd be like, I get all excited and take off. I was like, wow, it actually worked. Take off profits quickly,
Yeah.
like super quick. And then there were times where it was going against me, and then I'd be like, I'm just gonna let this hold. It's gonna come back. It's gonna come back.
Yeah, and you know what's funny? That's actually like a bias. The loss
Really,
aversion.
Mm-hmm.
Yeah, loss aversion's a bias.
Oh yeah.
You have people who will, against all logic, right, against all the probabilities, like there could be like a 1% chance of it coming back, but they'll be like, I'm gonna hold on in the hopes that it comes back. We got to think about that. Like, why does that happen, right? Like, imagine you bought something, right? You buy a stock at $10, thinking that it's gonna go to $15 in the next couple of weeks, and so you buy the position, and then tomorrow it drops to $8. You'll probably sit yourself and go, okay, well, I've got, my hypothesis was, 2 weeks from now, there's still 13 days or, 9 days of trading. It could come back, right? Realistically, it's day one. Then day two, it drops to $7. You're like, you know what? This is I was happy with it at $10, right? Anything below 10, I'm happy with it. So I'm going to buy more at 7. So you double up your position.
Yeah.
Then it goes to 6.
Even better.
You're like, even better. You know what? Yeah. This is, anything below 10 is a discount. Anything below 10 is a discount. Then it goes to 5. At what point do you go, I was wrong?
You have to do it.
Right? Because there's 2 consequences to this. It's like, one, you're losing money. You may think that, I haven't closed the position, so I'm not losing money. And like, sure, you can think that if you want, but your book value's down 40% on that trade. And the second side is you could have been in another trade. You could have been in a position that is doing what you thought.
Yeah, exactly.
Right. And sure, Jordan, do you have something you want to add to that?
I was gonna say like nowadays something that's changed for me so much is that I'll go into a trade, and then if it starts going red against me, sometimes I'll be like, you know what, I actually don't have confidence in this. I'll close it out, even for a small loss. I'm not afraid anymore to close out 50% of my trades for a loser. It's something that's come with losing so much.
Yeah.
Anyways, continue.
No. I think that's worth sticking on, right? It's like, if you're betting so much that if you're in a position where you like need this trade to go right, it's not a good spot to be in either.
No, exactly.
Like one of 2 things there again. Either one, your risk management's really bad, right? Because if you're treating your trading, like, so one thing that I always say is like, treat your trading account like a business. But I'm not talking in the sense like pay your dues, blah, blah, blah. I'm talking in the sense like you're trying to grow this thing, right? If you could grow your business at 50% a year, you'd be delighted. So don't worry if you didn't hit 400% this year. Focus on making money. The goal is to make money. Focus on that.
Like Aaron Brown said, I thought this was really good. It's like, to be a professional, to make money in trading, you have to see it done. So once you've seen someone make money trading, like who's professionally doing it, it makes it a lot easier for you. And I think that's so true.
Yeah, we want to expand on that. Why is that?
Yeah, it's like the nuances in the atmosphere that really help you, because a lot of the time, as a trader, for example, you are trying to take a directional bet. Let's say you're trying to forecast price. You're trying to forecast something. And first off, usually a lot of people don't have good models. But when you look at the real industry, so like let's say we're talking about the sell side bank, like sell side clients, right? So they're going to come in here and they're going to be like, well, Johnny's looking to make a trade, so I'm going to try to provide as much liquidity as I can to him and take a commission. So that's what's that's what's happening on the sell side. Okay, they're working for their clients, and then you have the buy side, which a lot of the time are working with, let's say, over-the-counter products. But what they're doing is they're buying something here and selling something that's relatively close over here, right? So they're taking a relative value approach, and seeing that done and seeing the bookkeeping and seeing how they're managing their risk is something that just like really gets you around that hump.
Yeah.
You know,
It
just
makes
like
things more real.
seeing it done. Yeah, exactly. It makes it real, and like things start to click when you start seeing someone do it professionally. It starts to click.
Money.
Yeah, it's
This
a
is
lot
not a
different.
gamble. This is someone making money in the market.
Exactly. I was on the phone with a trader at RBC the other day, and he was talking about how he thinks IV rank just sounds like gambling, right?
Mm-hmm.
You know, you're just betting. You're saying implied volatility. I'm selling because I think implied volatility is high. Like that sounds like a gamble, right? And this is a professional trader. You know, what he might do is he might say, well, implied volatility is high here, so I'll sell some options, and then can I go and buy some options on, let's say, a similar stock to hedge out that risk,
Yeah,
right? And capture the spread.
And that's the case, right? There's no like one like just indicator that like in and of itself. There's no golden indicator. There's nothing that you can go out there that's just free money, right? I think that's something people forget. It's like you can't just learn one little thing and it makes you money. It's just not how the game works, right? That's like, you know, thinking you can take an online course for marketing and become a digital marketer. It's like, sure, you can put it in your Instagram bio, you can update your LinkedIn, but you know, are you gonna make it in the field? Are you gonna make money? Are you gonna make money? Or are you gonna build a career in it? Are you gonna be able to do it profitably?
Mm-hmm.
I think that's the difference that people sometimes forget, right? It's like, in the end of the day, the goal is to win at this game. Right? If you want to just sound like you're winning at this game, you're doing great. Keep doing what you're doing. But if your goal is to actually win at this game, go all in. Learn the things that other people don't want to learn, right? Go talk to a professional trader. Like, go on LinkedIn, look up RBC trader, see who comes up, right? Send them a message. Say you're passionate about this stuff. Say that you understand that you've got a lot to learn. Can you point me in the right direction? Send that message to 50 people. One will get back to you. You know, maybe more. Right? If you come across as really nice and genuine and authentic and passionate, someone will get back to you, and you'll get some insight. You'll get some insight into what it really takes, and then you'll get to decide for yourself. It's like, okay, X, Y, Z are the skills that I need to learn to win at this game, and then I need to find a way to apply X, Y, and Z to the trading game. Am I willing to put in the work to do all those things to do it? And the benefit of doing something like that is that you'll then know by the end of it if you want to do that, if you're cut out for that, right? Instead of chasing your tail going in circles, right? Always sort of staying within your comfort zone, learning things that are familiar to you, because it's like, where else are you supposed to go? And then maybe not getting there, right? And but that's really cool about the professional trader saying that IV rank sounds like gambling, right? Because even if something has like a high IV rank, volatility can always go higher, right?
Yeah,
does it mean it's so? Okay, if something has an IV rank of what, like 100, is it fairly priced?
Well, yeah. Imagine. So the thing with the Tasty traders was that they were selling IV. So S&P went IV rank 100 in like mid-February.
Oh no.
So you know they were selling all the way up there, right? They were selling all the way from, you know, VIX 20, all the way to VIX 80. You know, so it was definitely tough. You know, it was tough for them.
And then they're saying they're going, why did this happen?
Right. Exactly.
How did this happen?
But yeah, no, I think if you see professional trading being done, I think it really opens your eyes to what's happening out there.
Yeah, let's pivot a bit here. So Jordan, what do you think? What do you look for in a trade? Right.
Yeah.
What does your process look like for finding a trade?
Mm-hmm. So like I do a couple of trades. So a couple of different strategies in my book. So there'll be one where, for example, I'm selling where I think, you know, implied volatility is higher than realized volatility.
Mm-hmm.
Okay, so you know, in the trading world, it's called volatility arbitrage. It's not really an arbitrage, but it's a statistical arbitrage.
Yeah.
So that's one. Then the other strategy that I have is I'm trying to buy something, you know, that's similar to this asset, And if this is cheaper than this, then I'll do it. Like, so for example, S&P 500 volatility is, let's say, 30%. Then I look at Apple and it's 25%. Well, what I'll do is I'll sell S&P vol and buy Apple vol as a hedge. So that's a lot of my trading. I'm just trying to, I'm not trying,
vol arb and relative value.
yeah, I'm not trying to like, shoot for the moon and hit 500% a year, right? Like, to do that, you have to have a directional edge and a volatility edge if you want to do that in option trading. You can have a real edge, so maybe an informational edge or a technology edge or something. It's like it's like the guy. So people think the word edge gets mixed up around a lot. A guy on steroids in 100-meter dash has an edge.
Yes.
Okay, that's what an edge is. It's something that makes the playing field unbalanced. RBC or Goldman Sachs getting access to low financing is an edge, right? They can put on risk reversals all day for basically no cost.
Yes.
When a retail trader can't do that. So those are edges. Yeah.
Okay. Yeah. And then, in terms of data, so where does your edge come from?
Yeah. So I try to go with the, so when we're trading, we always have to remember it's in a market, right? So there's other people on your side of the trade. So I try to put myself in a position where the guys who I'm trading against, I have more information than.
So you're more focused on like what table you're at rather than anything else.
100% of the time. I'm more focused on like, good poker analogy. I think that was great with the table is number one thing in poker is finding a good table, right? 100% agree with that. I'm not going to be playing in Apple during May when there's nothing happening. But if there's something like ACB popping up or USO, where I'm all over that, because now we have a huge imbalance where a lot of retail flowing in and not a lot of supply coming from the professional side. So I'll come in there knowing the product better than the people on the other side of my trade, and captures, make some money.
It's unbelievable the number of people who trade options that should not be trading options, man.
Oh, dude, it's insane. It's actually insane.
Thank you, Robinhood. Thank you, StockTwits.
Right?
You put money in my pocket.
Right. And I would also add to that actually about the strategies that I'm running is I'm bringing liquidity from one area to another area. Right. So let's say everyone is buying up S&P 500 calls and puts. That means there's a lot of action going in here, a lot of demand, and there's not a lot of demand happening in Apple. So I'm going to transfer that to Apple because I buy the Apple and I sell. Right. So I'm transferring liquidity from one area to another area, and I'm getting paid for that.
Man, that's a really cool way to look at it. I actually didn't think about it like that. Yeah. But that's pretty much what you're doing, right? You're fixing the supply demand balances on the two.
Exactly.
Trying to find like equilibrium on both of them.
Exactly, and I'm getting paid for it.
You're getting paid for it. That's your contribution to the market. Look at you, good guy. Good guy, retail market.
I don't know if I'm a good guy. I'm always laughing at the fishies. And,
no, but honestly, guys. So a really good way you can use StockTwits is two things. One, you could literally go and just do the opposite of people on there. Most times it'll work out. I'm messing around there, but what you can do is there is a feature within StockTwits called I think it's called Market Sentiment. Is that what it's called, Jordan?
Yeah.
I have it open right here. Let me see.
Yeah, it's called Market Sentiment. Sorry.
Yeah. So right at the top, you can click. You have price, you have message volume, and you have sentiment. So if you click on the sentiment for any given stock, it will tell you based on the selection of people posting on that board and the language that they're using, whether they are generally bearish or bullish. Now, guys, this is actually an unbelievable way to validate your position, right? If you're bullish on something and you go into StockTwits and you see that everybody is bullish, what are the odds? Somebody has to be wrong, right? You got to remember this. Like, somebody has to be wrong in trading. There's a winner and there's a loser every single trade. Why? Because you take a position and it gets filled. There's somebody on the other side of that filling, taking the opposite bet of you. So when you make $1, someone else loses $1. So do you want to be on the same side as everyone else online? Who's on the other side? Right? If everyone's bullish, who's bearish? Who's selling you stock? Who's selling you options? So we need to keep that in mind when we look at a position. And StockTwits is an unbelievable resource for doing that. you can actually go in and say, okay, am I on the same side as, the retail money? Right? In the end of the day, you want to be on the right side of the trade. And that's one way to add a layer of analysis quickly and easily that actually holds some value. We have, we need to do some testing on it, but it seems to be working because that's the retail money. You don't have hedge funds on StockTwits. You don't have, pension funds on StockTwits. You don't have big insider trading happening on StockTwits. The guy who says insider trading is happening, I'm sharing it for you guys here on StockTwits. Like, I've never seen that. And if I have seen that, it's bullshit. It's not real. Come on, the insider trader, all you need to do to find that, well, first of all, it's really hard to find, but you can look at who's buying up options, right? Yep. Why did 10,000 contracts just get bought today way out of the money for an inflated price?
I don't know if you're looking at it right now, but NASDAQ is taking a dump.
Is it?
Yeah, it's getting spanked. Things down just over 2% right now.
No way.
Yeah.
Oh. The beginning of the end, boys.
It's the beginning
Load
of
up
the
on
end.
your puts.
Yeah.
Load up on the puts. We're going down.
But yeah, Sean, I think what you're saying there is pretty sweet, dude. It's pretty sweet stuff. Pretty good insight.
It's just think about it. It makes so much sense. Why would you want to be on the same side as all the retail traders?
Yeah.
It's like,
that being said though, like there's some good times to jump in early.
Yeah, because they can push the market.
Because they can really move it. Like look what happened to Zoom, Tesla. Maybe not so much Tesla.
What happened to the mini Zoom? So it didn't happen to ZM. It happened to Zoom. They weren't big enough to move ZM.
Right.
But they can move ZOOM, right? We're talking about the tickers. I don't know if you guys know about this. This was like some really funny stuff that went down. So when quarantine first started, basically a bunch of and it makes sense. This is a logical bet. It's like Zoom is it's obviously not enough to place a bet because everyone else knows this as well. But it's like Zoom is the biggest video platform used by businesses, or one of them at least. And if we go into quarantine, more businesses are going to be doing, meetings online, et cetera. Zoom Pro subscriptions are going to go up by Zoom. So you had a massive influx of retail traders come in and go, I want to buy Zoom, type in Zoom stock, and the ticker ZOOM came up. Now, Zoom as the ticker is not Zoom as the company. Zoom as the ticker is actually some sort of like research company or something. They're something completely different. They were not video technology. They're nothing to do with anything. And that stock went from $2 to $50 in like a week. They came in, it was just like rocket taken off, went to the moon. And then news came out that they bought the wrong company and it went right back down.
Yeah.
Zero.
Yeah. So like these are inefficiencies that happen in the market, right? So as a trader, we're trying to find inefficiencies. Not saying that we don't want to forecast, but the truth is forecasting is really hard. So instead, what we want to do is we want to find an inefficiency, right? So obviously we didn't take advantage of that because we weren't covering the stock. But if you spent the time and you're reading all the research reports and all that stuff, you would have actually you might have found it, and then that's it. That's a blatant short. So keep that in mind, guys. Like when we're trading, we're always looking for inefficiencies. We're not looking directly for we are not trying to forecast directly.
Very cool.
Is there any questions today?
We don't have any questions today. Danvir, if you're still here, man, no questions for us today? And I'll be sending you over an email, Danvir, shortly after this live. But if we have no questions, guys, we're going to wrap it up here. I'm going to clip that up, actually. That was a really good live, Jordan. I think there's nice. a lot of really good talking points there that people, in the end of the day, guys, what we need to be doing is we need to be thinking critically about trading, right? Don't take it for granted, right? And like, a lot of people put in the time of putting the work, but stay within what's comfortable, right? So like, if like, have you ever heard the saying, it's like, if you've never failed, try harder. Have you ever heard that, Jordan?
No.
Yeah. It's like, if you have never failed before, then you never actually found out what your potential is. You never pushed yourself to the point where you actually know how much you're capable of doing. So if you've never learned to trade and it's felt uncomfortable, if it hasn't sucked, if you haven't wanted to give up, you have not pushed yourself to the point where you're reaching your max potential in trading.
I like that.
Yeah, it's the same in every field. You want to be the best. It doesn't like what are the odds that you are the natural born Picasso of trading? What are the odds, right? Maybe you are. Maybe you're the one in, I don't know, a million, right? But you don't need to be that to be a good trader. Hard work does win. Hard work pays off.
Yep.
But it's hard work put in the right spot. And that right spot is definitely not within things that you knew prior to coming into trading. It's hard, but it's worth it. So, with that, guys, I think we're going to end off the live here.
Nice.
Leave you with that to think about. We can talk about that if you want. You can send me an email. Type my email in the box. If you liked what we're talking about on this live, you have any questions for us? Actually, okay, here, wait, before we go, actually, you know what, Danveer. So Danveer wants to talk about risk management on small to mid-sized accounts. We can cover it live tonight, actually, if you want, Jordan.
Yeah, well, we can quickly go over it.
Okay, let's go over it quick.
Yeah. Risk management, small to mid-sized account. So account size.
Because everyone left already.
Gotcha. Okay, so in regards to account size, unfortunately, you're going to have to pack on some more risk if you've got a small account, right? So you want to have, let's say, your max loss on a trade anywhere between 5 and 10%. So let's say you're doing an iron condor, or butterfly, keep your max risk to 5 or 10% of the account. It gives you some wiggle room to make a few mistakes along the road.
Mm-hmm. Cool. And then in terms of the account management, oh, perfect, Danveer. Glad you're still here. In terms of the account management, it's same thing that we talked about before, right? And we go a little bit more into detail to it in the group, but it's like if your risk tolerance is hit or the edge goes away, right? Like we're not going to see 5% profit and be like, yay, take the money off the table, and then like start seeing some losses and be like, it'll come back. That's not the game we're going to play. And like we can go into detail on that if you want later. But I think we covered that pretty well at the start of this as well. But we'll make sure that you get a grasp on that. Okay.
All right,
guys, if that's it, we're going to be heading off here. Thanks everyone for tuning in. If you haven't, make sure to subscribe. We're live here every day, releasing a ton of content, really trying to grow this community. I think quantitative trading, right? Not AI, none of this other stupid stuff, just this application of simple statistics, being critical of ideas, testing your ideas before you put your money behind them is something that the market needs. Traders need this if they want to win. And by you subscribing and liking this video, you really help out. So thanks a lot, guys, and we'll see you tomorrow.